Hi guys, as you all know, this is a teaching channel and I make videos on this channel to educate all of you and to ensure that all of you learn the right way. I'm not interested in taking or conducting any webinars. It's become a style nowadays, and especially since the lockdown, a lot of people have come into this field conducting webinars, and some of them actually teaching some very good stuff, but most of them just looking to present the same old stuff in different ways and fancy ways, which is absolutely unnecessary. I'm here to discuss the entire anatomy of a candlestick, reason a candlestick is formed at various locations, and which all candlesticks are important to be read on the charts, and which candlesticks that you should be trading upon. Everything we will be covering in today's video. This is going to be a long video because this is a masterclass, and trust me, once you master this video and master the techniques in this video, there is really no place that you need to go and spend your money on paid webinars and paid seminars to learn price action. This is absolutely the very method that I use for my trading, and this is the method that changed my entire trading career. It took me a while to learn this trading, and it might take you a while as well. But trust me, if you are an absolute beginner, it is going to take a longer time. But if you have been exposed to the stock market or to trading for some amount of time prior, then you don't need to spend, or it won't take a lot of your time from now on. This is not a strategy that we are going to talk about. This is pure price action that we are going to talk about. This is pure candlestick anatomy we are going to talk about. What sort of candlesticks are formed, what their names are, and how to learn these candlestick patterns and follow them on the live chart. This is what I'm going to teach you in this masterclass today. Now, I have made multiple videos on strategies which you can use in the live market. Just apply these candlestick formations on those price action videos and trade from there. And I call this the masterclass because this is exactly what I learned in my personal trading career, and it is that has entirely altered and changed my trading career to take me on the successful side of trading. And in this video, we're going to cover the extreme basics of candlestick anatomy. You might find it a little rudimentary initially because it's at a very primary stage, but as I said, my channel is all about teaching. This is basically meant for all those people who are watching this channel for the first time, or watching this video for the first time, or who are new to trading. And I'm here to teach and educate all those new traders, and I'm interested in teaching and educating all those new traders who are aspiring traders and who are just starting, or all of those traders who are still struggling to make money in this market. Guys, making money in this market is not difficult. It is just a matter of time before you start making money. But the trading decisions, the entry points, the exit points, it's all a very important aspect of trading. It has to be a complete formula. It is not the strategy that's just important. I have shared multiple strategies in my strategies section. You can just go out there and use any of those strategies in your trading career. Any one strategy is also going to make you a successful trader. You have to understand that taking multiple entries in a week is not important. Even 3 or 4 entries in a month is going to be enough to make you a profitable trader if you, with a lot of discipline, learn to follow candlestick patterns. It's never a very difficult job to achieve success in this market. See, in this market, there are only 2 things that you can trade. What are those 2 things? One is the breakout and the other is the reversal. So at an important resistance, if price tends to go towards a resistance, the price is going to either break out of that resistance or it's going to return from there. So it's going to either reverse or break out. It's common sense, right? But at that position, what do you exactly look for? What tells you that it's a successful breakout, or what tells you that it's going to be a successful reversal, is what we are going to talk about in this video. Guys, learning price action has its own learning curve. It takes time, but once you learn it, trust me, this is a skill that you will acquire for your whole lifetime, and it's never going to take too much of your time to learn it. Just give it a week's time. Watch this video again and again if you need to. Watch the section in which I am going to describe each and every candlestick pattern to you. And it is patterns of these candlesticks, these candlestick formations that are really, really important. Some may be single candlestick patterns, some may be combination candlestick patterns, but they basically mean one and the same thing. I'm going to explain all this to you on the charts. So which candlestick patterns to follow at breakouts, which candlestick patterns to follow at reversals. All this we are going to cover in this video, and please ensure that you watch this video till the end so that you don't miss any part of this video. Don't skip and watch, please, because if you don't have time right now and you skip and watch right now in a hurry, you're going to have to come back and watch this video later again. Rather, I would say if you're not going to be able to see this video right away and you've clicked on it already, then please add it to your watch later list and then go ahead and watch it maybe sometimes at night when you're relaxed, where everything is silent, and then you can purposefully be focused on this video itself. Before we hit the screens, please ensure that you smash the like button if you've not already, and ensure that you subscribe to this channel and also hit the bell icon so you're notified each time I post a new video. Please ensure that you share this video also as much as possible so that I can reach out to more and more aspiring traders also. So now let's go on to the screens. Welcome to the screen, guys. So this is the masterclass on candlesticks, and let's see what you will learn in this masterclass. So the first and the most major thing that you will learn in this is you will learn the major types of candlesticks that you will ever need. So you will not need anything other than these candlestick patterns to trade on in any sort of markets. Now you can use these on currency markets, you can use this on stocks, you can use this on indices. This is pure price action, this is pure candlestick formation, and candlestick formations are universal, they don't change. Alright, so you can use these on any instruments that you are trading on. The second thing that you will learn is the combination of candlesticks. Now what does the combination mean? What does this mean? That we will see what multiple candlestick formations mean. I will initially explain to you the anatomy of the entire candlestick family, and then I will tell you how to read the combination of candlesticks also. What is the next thing we will learn? The third thing is how to read buyers and sellers sentiment at important locations. So what is the sentiment of buyers and sellers? Now the market goes up and down by the buying and selling of buyers and sellers, right? There is no other force that takes markets up and down. It is pure buying and selling that takes markets and takes price up and down. So you will learn this particular phenomenon in this video. And where is it happening? Is it important to see where price is going up and down everywhere on the charts? No, it is not. It is only important at important locations. Okay, so it's important to see what price is doing only at important locations. So in effect, where do these candlesticks get formed? They must get formed only at important locations. Otherwise, nothing else is important to you. Okay, wherever candlesticks are forming, you need to see that there is an important resistance or an important support or a supply demand zone where they are forming. Only then those candlestick combinations mean something, otherwise they don't mean anything. Okay, so you don't have to pay any attention to any other candlesticks on anywhere on the chart. Now the fourth thing that you will learn is how to analyze what the market might do next. Okay, so here what this point means is you can analyze what the market might do or where it might go next based on candlestick chart formations. So wherever the candlesticks are being formed, let's say that there is an important resistance, a prior resistance where price has fallen initially, and later the price goes there and makes a bearish or a reversal kind of a pattern candlestick, then you know that the market might go down. Or if it's an important resistance and price has initially fallen from there, and you know that it is an important resistance or a supply zone, and now when price reaches that level, it forms a bullish breakout candlestick, then you know that the price might go above and travel till the next important resistance. So you will be able to analyze where the market might go next based on these candlestick formations. So let's go to the next slide now. Alright, now here we will start to learn the heart of all this entire masterclass. Okay, this is the most important part. You need to learn the candlestick anatomy. What is candlestick anatomy? Candlestick anatomy is reading the body of the candlestick, how the candlestick is formed, what it means, and how to read a candlestick. Let's see what the candlestick tells us. Now the first image is of a green candlestick. What does this show? That the candlestick opens at this area and it closes at this area. This is the close. So the close is higher than the open. You can see the black dotted arrow here that shows that the close is higher than the open. What does this show? That this is a bullish candlestick. Okay, and this entire green part of the candle is called the body of the candle. You can see here they've written the body here, right? So it is the body of the candle. Now what is this? The one that is shown above. Let me tell you that first this point is the high of the candlestick. What does this mean? Price basically opens at this area, then it first goes down, it makes a low here, and then the buyers have completely pushed the price up to this area, and then from this area this candlestick travels up to here and it closes. So this particular thing that you see on top here is called the upper shadow or the wick of the candle. Here you see a similar wick on the bottom. At this area, this wick is called the lower wick or the lower shadow. So you can see that the price made a low point there, the candle made a low point there, and then it proceeded to go upwards. Okay, now this could be any time frame. Okay, it could be 1 minute, it could be 2 minutes, it could be 3 minutes, it could be 5 minutes, it could be 15 minutes, 1 hour, it could be 2 hours, 4 hours, or even a daily candlestick, a monthly, a weekly candlestick. So the candlesticks can be broken down into various time frames, right? And whatever time frame you select on the trading platform, that is the time frame that the candlestick will represent. Okay, so you have to understand that any sort of candlestick or any time frame that you use, the anatomy of the candlestick does not change. Now let's go forward to the red candlestick. Now what does this suggest? First thing, that this is the body here, that is the red body. Now what does body mean? The body means that there are sellers there, and you can see this black dotted line which is pointed downwards. So basically the candlestick has opened here. You can see here that the candlestick is opening here. Then what it does is it goes ahead and forms a high here. So a very small push to price by the buyers, and from here the sellers have pushed this candle down to the low, and then a very small push by price from the bottom, and then it closes at this area. Okay, so this is what a candlestick formation shows you. This is what a red candlestick formation will show you. Let me explain to you again. This here, the candlestick will open at this point, then the buyers will push the candlestick upwards. It will make a high at this point, and then the sellers will become strong and they will push the price right up to the low point. And at this particular low point, the buyers will come in, it will step in again. So here we will write B, the buyers, and the buyers will step in and push the price upwards, and here at this point the price will close. So there the buyers have pushed the price slightly upwards. Now does this mean that the buyers are strong? No, it doesn't mean that the buyers are strong. We will see where the buyers are strong and where the sellers are strong in the upcoming slides. But you can see here that the most important part is that this is the body of the candlestick, and this is the wick, and this is also the wick. What does the bottom wick suggest? The bottom wick or the lower shadow, it suggests that there are buyers on the bottom. And what does the upper shadow or the upper wick indicate? It suggests that there are sellers on the top. Okay, so price is not being allowed to go up by the sellers, and the price is not being allowed to go down by the buyers. So I hope this candlestick anatomy part is clear to you. If it's not, please go ahead and watch this part of the video again. Now let's push forward to the next slide. Okay, now we see here, first let's get out the doji candlestick. Let's get this out of the way. Now in the previous candlestick we talked about what a candlestick anatomy is like. Now let's apply this candlestick anatomy to this particular candlestick. What is this candlestick? The candlestick has opened here, and here the sellers have probably pushed the price lower first. Then the buyers have come up and pushed the price up here up to this point, and then the sellers have come up and the candlestick has been pushed down up to this point only. But since the candlestick opened at this point and it has closed at this point, it is still a green candlestick. Okay, and it is a green candlestick, but then you can see how long these wicks are on the bottom and the top, and you can see how short or how narrow this body is. It's a very small body, right? Now I'll tell you what this means, but first let's study the red candlestick pattern. Okay, now the red candlestick will open at this level, and then it will first make a high here. From here, sellers will come into action and they'll push the price up to the low point, and from the exact low point out here, the buyers will step in, and then they will overcome the sellers and they'll push the price up here. But then by that time the time frame is over, so the candlestick will close here like this. Now again, the candlestick time frame could be anything. Okay, it could be ranging from 1 year to down to 1 minute also. So it doesn't matter what the time frame is. So I hope this part is clear to you. Now the body being so small in both these candlesticks, do these candlesticks really mean anything? See, the body is very small, right? And the wicks are very, very big. Now it does not matter whether the color is green or the color is red. Since these are such long wicks, the high suggests that there are sellers up here and the low suggests that there are buyers down here. So what does this indicate? It indicates that there is a crunch between buyers and sellers. See these candlesticks also, very, very small, very narrow bodies. But look at the wicks. The wicks are so huge. It suggests that the body is crunched, which means that the buyers and sellers are applying equal pressure from bottom and the top respectively. And so these candlesticks, the doji candlestick, basically indicates only one thing. What does it indicate? I'll write it down here for you. It basically indicates indecision. What does indecision mean? These are indecision candlesticks. What does indecision mean? The buyers and sellers are not exactly decided which way the market is going to go. So why does doji form an important part of candlestick masterclass? They form a very important part. The reason being that during such candlestick formations, whenever such candlesticks are formed, you are supposed to stay out of the market, because if you get in, you're going to get into a slugfest between buyers and sellers and you're going to get crisscrossed and whiplashed from both sides. So you don't want to take anybody's side when these type of candlesticks are being formed, where buyers and sellers are completely undecided where they want to go, whether the buyers want to take the price up or whether the sellers want to take the price down. They have no idea. So that is why the market itself is undecided, and that is why you should stay away from the market at such times. So I hope you've understood the concept of doji candlestick and why you should stay out of the market. Now the sentiment, as I talked about in the initial slide, the sentiment here is that the market is undecided. Both buyers and sellers are undecided where the price is going to go. So you will stay out of the market and you will not take any decisions when such candlesticks are formed. Let's go to the next slide now. Now the most important candlestick, the bullish or the bearish Marubozu. Now Marubozu here means that a candlestick which is formed which has negligible wicks or no wicks at all on either side. So here let's talk about the green candlestick first. Now this is a green candlestick, right? So let's talk about this first. So it could have a very small negligible wick on the top like this. It could have a very small negligible wick on the bottom like this. That does not matter. But what matters is, look at the body of this candlestick. It is a huge body, right? Now this huge body suggests that there is immense buying strength in this candle. So where is this candle important? I'll let you know in a while. Let's first talk about the red candlestick. Let's say that this is a red candlestick here. So what is important to know here? That this is an absolute seller's candlestick. Look at the body. It's a huge body. So it might have a small wick on the bottom. Now what did I tell you about the wick? I told you about the wick in the initial slide, that the wick suggests that there are buyers on the bottom and the wick on the top indicates that there are sellers on the bottom. Now on a red candlestick, this wick does not matter, but this wick, does it matter? No, on such a huge Marubozu candlestick, it doesn't matter. So there could be a wick or there could not be might not be a wick. Again on the green candlestick, this candlestick suggests that there are buyers on the bottom and this suggests that there are sellers on the top, but is this wick really consequential? It is absolutely inconsequential when you see that the body is so big. It's so huge. Okay, so you have to understand that while looking at candlesticks, you have to study the percentage and the proportion of these candlesticks on the charts itself. So I would suggest you to see or have a 70% to 30% ratio from body to wick, and higher the better. So if it's 80-20, it's even better, right? If it's 90-10, it's even better. And 100-0, absolutely beautiful. Okay, but you'll rarely get this 100-0 kind of a thing. You'll mostly find a small wick on either side. But any of these three structures of candlestick, body to wick ratio I'm talking about, okay? This is the body and this is the wick. So if there is about anywhere between 10 to 30% of the wick compared to the body, then that is fine. So as I've just drawn here, such small wicks on the top and bottom are inconsequential. So it doesn't matter. Such candlesticks are usually formed when there is a support or a resistance that is broken. So let's say that this is an important resistance. Okay. And let's say that this candlestick has come up to this resistance after breaking this one resistance here. So if this is a top resistance and this is one resistance on the bottom, then understand that the buyers have overcome this resistance, but now there is an immediate resistance in front. So now this candlestick is not important. But where is it important? It is important where probably it has broken through a resistance like this, and then there is no resistance on the top. So you know that a prior resistance where prior has gone like this and gone down, and then it has formed this particular green candle. Now this is a breakout candle, and then you can take a trade on this breakout candle. Now how to take trades on these and how to place your stop losses and where to book targets, I have made videos on all these in the educational section and in the strategies section. You can go ahead and check all these videos. But now you can understand here that the resistance here has been broken and a huge candlestick has been formed. So this is a particularly breakout candlestick pattern. So Marubozu candlesticks are formed exactly at breakouts. Similarly on the downside, now if you see that this is a support line here like this, so let's write support here. And this red candle has broken through the support handsomely. So this is a good closing, right? You can see that the closing is much below the support. So this is a handsome closing. And now you can short this candlestick. Of course, it all depends on what kind of strategies you're using, but here we're talking about only candlesticks, right? So these are particularly breakout candlesticks. So you will see these strong bodied candlesticks at breakout lines. But then now if you see here that a resistance has been at this particular range and this big candle has broken this resistance, does this candlestick now mean anything? No, you should not go ahead and trade long for this candlestick. Similarly, if this particular candlestick has broken a support like this, then there is really no margin on the bottom that can suggest that the sellers have really overcome this support, and so the buyers can easily push the price up from here. And so this amount of margin is not enough for us to trade. It doesn't matter how big the candlestick body is on the top. It has to have a proper margin of breaking the resistance or the support line. It is very specific to that particular stock or that particular instrument that you're trading in, maybe currencies or maybe in indices. So I cannot really give you an idea of how big the margin should be, but you will have to visually decide it, and that will take experience. So with experience, you will understand that the price action there has to be read in a particular fashion. Now, every instrument will have its own personality. Okay, so you have to go by that instrument's personality. So basically, Marubozu candles will be formed at breakout lines. I hope this pattern is clear to you. Now let's go to the next slide. Now we come to another very important pattern, which is called a hammer or a bullish pin bar. Now what is this? Why is it called a hammer? We will talk about this pin bar first, and then we will go ahead to see what all combinations lead to this pin bar. This one pin bar, if you trade all your life, forget about the Marubozu, but if this pin bar is what you can master, is the only candlestick pattern that you can master in your entire life, your entire trading career, then you will be able to take your trading career to a whole new level. Trust me on this. This is the most important candlestick that you will ever find on any chart, on any instrument. This suggests a complete reversal in sentiment. Now here we are going towards the reversal pattern candlestick formations, and here we are talking about a bullish pattern only. Okay, we are not considering bearish patterns. Now let's go ahead and see where this particular pin bar, bullish pin bar, may be formed. Now if you know that there is a particular downtrend to price like this, so what is happening here? Price is basically coming down on a downtrend, isn't it? And then at a particular point you see that there is an important support or an important demand zone, and then at this point you see that there is a smallish body but a long wick on the bottom, kind of a pin bar candlestick formation. Now this pin bar is very strong at the demand zone or a strong support like the CPR, or a strong support prior the price has reacted to it by bouncing from that point. So then you will be able to mark that support, right? You have a historical support there. So whatever it is, the CPR or a demand zone or an important support coming from prior price action, whatever it is, if you see that there is a negative emotion in the market, there is a negative sentiment in the market and the price is crashing, and suddenly a bullish pin bar is formed, then this is your signal to go long, provided you have this sort of a support there, an important support there. Okay, and so this particular bullish pin bar suggests that there is going to be a reversal to price. Why does it suggest that? Now let's talk about this. Now what forms this pin bar? Let's talk about this first. Where is the open of this candle? Since it's a green color, the candle open is here and the candle close is here. What is this? This is the high of the candle, this is the low of the candle. What happened here? The candle first opened at this point and the sellers were in control. They pushed the price to the low, and then the buyers were so strong that they came back bouncing from the low and they pushed the price right up to this point, and there's a very small wick there, inconsequential, so the candlestick closed here. The sellers applied a little bit of pressure and the candlestick closed there. But what is the most important point is this particular line here. The buyers have completely overtaken or overcome the sellers in this particular time frame, and that has happened at exactly the support. Okay, so if this is the support line that you have seen and prior there has been an initial downtrend like this, and then you see a pin bar form there. Now what do you know here? You know that the sellers have taken the price from here to here below the support, and then suddenly the buyers in the same candlestick have pushed the price up to this point, and then you can see that a very inconsequential wick on the top and the price is closed above. So now you know that this particular support is holding very strong, and that is your indication to go long. So you see why the bullish pin bar or the hammer is such an important candlestick pattern to trade on. This is the reason why. Now we will go to the next slide and we will see what the next slide shows us. The bullish pin bar was the single candlestick pattern that I showed you. Now we will be going towards the combination candlestick patterns. Okay, so now we are looking at a bullish engulfing pattern here. What is a bullish engulfing pattern? Let's say that you have a red candlestick and here the price has been falling. So there has been an initial downtrend here. Okay, and let's say that somewhere around this area you have a strong support. Okay, and the price has been pushed down to the support, and the red candlestick, which is this candlestick, is a very strong candlestick. You can see the wick on the bottom, right? It's a very small negligible wick. But now what happens here? Now this green candlestick is formed next to this red candlestick, and this green candlestick has completely engulfed this red candlestick. You can see the body, it is within the body of the green candlestick, right? And this entire candlestick is within the high and the low of this particular candlestick here. So you can see the high and low, it has been formed within the next or the consecutive candlestick here. So what does this suggest? That this particular green candlestick here has completely overcome and completely engulfed this red candlestick, and hence the name bullish engulfing. So it has completely hidden or eaten away the red candlestick, right? The green candlestick has completely eaten away the red candlestick. And what does this suggest? That the sellers have been completely absorbed by the buyers, and the selling has been absorbed, and the buyers have come out victorious at the support. And so this is your signal to go long on at an important support. Understand that we are talking about all these candlesticks at important supports because we are presently talking only about bullish candlestick patterns. Okay, don't worry, I'm going to take you to the bearish ones also. So I hope this candlestick pattern is clear to you, and this candlestick pattern happens mostly at the support areas wherever you see that initially there is a downtrend. So understand that these are all reversal candlesticks. Okay, so if there is a price action which is sideways and then you see this kind of a pattern, it does not mean anything, but there should be a preceding downtrend to it. Okay, so understand that in every pattern that I'm showing you, there has to be a preceding downtrend. Okay, now let's push to the next slide. Now I want to show you what this combination means and why that combination is important. So the combination of the bullish engulfing that you saw, this here shows us that this particular red candle plus this particular green candle gives us a bullish pin bar. Why does it give us a bullish pin bar? Now imagine this red candlestick here. It has been formed like this, right from the open to close. And suddenly next candlestick forms a green candlestick. So this entire body up to this point has been taken away by the buyers, and then the close is right here, right? So the high and the low will stay the same. So what is the high of this? It's the high of the combination of these candlesticks, and the low is the low of the combination of these two candlesticks. Okay, so the high and low will remain the same. If you can see here, the high and low is at the same point, right? So here is the low and here is the high. They're at the same point here, right? And what changes is the open, and what stays the same is the close. So what is the close here? It is this line here of the second candlestick, but the open now becomes, instead of this, right, this open now becomes the open of this particular pin bar's open. And as you saw in the initial slide, you saw the anatomy of the pin bar, and I told you why that is the only candlestick that you will ever need to learn to be a successful trader. This is why all these combinations that I'm going to show you will lead to a pin bar. So always understand that these combinations will always lead to a pin bar. So the pin bar is the only candlestick formation that you need to learn, and you need to learn these combinations only to see whether they are adding up to a pin bar. And the Marubozu is the only candlestick that you will need to learn to handle breakouts. I hope this combination is clear to you. Now let's go to the next slide. Alright, now a combination of candlesticks and a pattern which is called piercing line, which happens very regularly in Nifty and Bank Nifty. So what is a piercing line? So a piercing line happens at the end of a downtrend. Okay, if there's a downtrend like this, and then you see that there's an important support somewhere. So let's say there's an important support at this area. It doesn't have to be at the low, okay? It could be anywhere here. And now what happens here is the sellers have been strong in this candle, right? The sellers are very strong in this candle. They pushed the price from here to here down, from the open to close, or rather from the high to the close, rather, we would say. And now from here what happens is the sellers are so strong that they've pushed the price down. So the next candle has actually gapped down open. So you can see that the candle is open here. So where is the close? You can see that the close is here and the open is down here, right? So there is a gap down opening for the candlestick. And this gap down is because the selling is so strong that before this green candlestick is imprinted, the price has already fallen so sharply. But now what happens is the candlestick opens below the red candlestick, and the green candlestick here now overcomes the red candlestick by more than 50% and closes. So you can see that this line is more than 50% of this particular red candlestick. It is very important to understand the 50% formula. Why? Because the 50% line has been breached and this candlestick has completely overcome the red candlestick. Again, what do you see here? What remains here is a particular pin bar. So let's draw a line here and let's equate this, and you can see now that this is the candlestick like this, and there is a high here. So we'll mark a high here. This is the wick, and then from here to here, right up to the low of those two candlesticks, like I said in the previous example, the low of those two candlesticks right here will become the low. Now what does this indicate? This is again a pin bar, and this color doesn't matter even if it is red. What matters is the wick on the bottom. This wick is also much smaller. Okay, so this wick does not matter, but this wick on the bottom is a buyer's wick exactly at the support line. So this suggests to us that the buyers have entirely erased the sellers right from this particular low point. So they have basically gone down to this point, and from there they have bounced up to this point, and they have taken out 50% of the red candle. It is a very important point. Okay, so if you see something like a candle which closes down here, then this is not a piercing line. Okay, you have to understand that it has to close above the 50% of the red candlestick. So then it will equate to a bullish pin bar itself. So you should be able to analyze this in the live market. So this was the piercing line candlestick pattern, which is a bullish reversal pattern. Let's go to the next one now. So now we are going to the inverted hammer or the bearish patterns now. Okay, so these will be bearish patterns. This is a bearish pin bar. It's the same like a reversal candlestick pattern for price where we saw that the price comes down to a support and then it reverses with a bullish pin bar. Now this bearish pin bar happens at a resistance. So let's say there is some sort of a resistance at this point and the price has been going up like this and it hits the resistance here, and then this particular pin bar is formed. So this pin bar, what does it suggest? This red pin bar suggests that the sellers have been strong. So this wick on the top suggests that the sellers have completely taken the price down at the end of an uptrend up to this particular level here, and the candlestick has closed at this point. So what happened here? The candlestick actually opened at this point. Let me just delete all this so you can see all this clearly. See, the candlestick basically opened at this particular point. So this is the open. Then it was pushed up and the buyers made this particular high here. And then the sellers were so strong that they pushed the candlestick up to this point, and then a very negligible wick on the bottom, and the price was, or the candlestick was closed at this point. So this is the bearish pin bar, and you will see this pin bar as a standalone candlestick, or we will study what sort of combination candlesticks shows us the pin bar. Remember this, that this will be formed only at important resistances. Okay, so let's push ahead and check the next slide. Now we see a bearish engulfing pattern. We've seen the bullish patterns. Now we are seeing all the bearish pattern. Okay, so these are exactly the opposite ones. Now let's say that we have a resistance somewhere here. So price has been pushing upwards. It has been on an uptrend, and this particular green candle has been formed exactly at the resistance level. But the green candle, in spite of this breakout here, has not been able to close with a good margin, and then suddenly the sellers have been successful in pushing the price down with this huge red candle. So the price has been pushed down below the resistance and this particular candlestick has been formed. Now what is the important idea here? That this particular red candlestick has completely engulfed this green candlestick, which means that the sellers have come in strongly at this particular resistance, in spite of the fact that you can see that it has been a slight breakout there, but the resistance is still holding. And so what you can do is you can open a short position after this candlestick is formed. So I hope you have understood this. I will not explain to you in so much detail as I had explained in the bullish patterns, but I'm explaining the important parts to you here. If you've not understood this, please go back to the initial part of this video and you can study it from the bullish side also, which will help you understand the bearish patterns. But understand here that again, if you want to form an equation out of this, what forms here is the high here will stay the same. Okay, so let's say that this is the high of this candlestick, so that will stay the same, and the body, the open, will be here. Okay, so what does this suggest? That the open of this red candlestick has completely taken off this candlestick. So what is the open now? This will be the open now here at this point. So you can now see that we have a very small close of the candlestick at this point, and there is a low point here. Okay, so what do we see here? How do we calculate the candlestick? Let's combine these two and draw a combination candlestick. So right from here, since the sellers have overcome the buyers, there will be a simple wick, right? Only the wick will remain because the body has now been completely overcome, right? This body has now been nullified completely. So there will be only a wick there, and then on the bottom you will see that there is a very small body, because this happens to be the combination of these two candlesticks, right? And then you will see that where the close is this point here, right here. So this is where the close is, and this is where the low is, open, and you will see that this is the high. So this is how you basically will read a particular candlestick. So this combination shows us basically a bearish pin bar. So what does it suggest? That only the pin bar is what will be the most important candlestick that you will require while trading reversals. So you should only be able to combine these two candlesticks together. Let's go to the next slide. Now we are seeing a dark cloud cover. We already saw the piercing line, right? And the dark cloud cover now is exact opposite to the piercing line. So what happens here? Now here there is an initial uptrend. Okay, there's an initial uptrend from, let's say, this point. Price is going here, and then suddenly a green candlestick is formed, and let's say that there is a particular resistance at this line here. It doesn't matter where the resistance is, it is a resistance at this point. It's an important resistance, okay, or a supply zone. So now the green candlestick has not been able to close above this candlestick, but the buyers have pushed the price up. The buyers are so strong that before this particular candle, the red candle was imprinted, the price already shot up to this level here. That is so strong buying. And suddenly, after the buyers took the price up to this level and made a high, suddenly from the high, the sellers have pushed the price all the way down to the low, and then an insignificant low, and the price closes at this level. So what does this show us now? That this is a dark cloud cover. Again, as I said, the 50% rule here applies. Okay, so this particular candlestick has to be taken out more than 50% by the red candlestick here. So the red candlestick must close below the 50% mark of this particular green candlestick. That is when a dark cloud cover is formed. If it closes somewhere here, then that is not a dark cloud cover, in spite of the fact that the other things might be the same, but the 50% rule is the most important rule here. Okay, and then if you go and equate these two candlesticks, you can again see that the high is here, so the wick will be up to this point, and from this point you can see that there is a very tiny body to the candlestick up to this point, and then there's a very tiny wick on the bottom like this, right? So because the now the open at this point will be at this level here, and in spite of the fact that this is a green body, this will remain green, right? Because this candlestick has ended here at this point, the red candlestick, and the green portion here will stay green. So it doesn't matter. So there is a resistance line here, and it doesn't matter if it's a green candle. It still means that it is a bearish candlestick. In spite of the fact that it might not be red, it will still be bearish. I hope you've understood this part. Now let's go to the next candlestick pattern. Okay, now here we are seeing inside bar or Harami pattern. So what does this mean? Now we can see that this is a preceding candle, and this is an inside bar which is formed inside the high and the low of the preceding candle. So what have they written here? High and low of the inside bar is completely covered by the preceding bar high and low. So the high and low here are right within the initial candle's high and low. So this entire candlestick, body and wick included, has to be within the preceding bar's high and low. And what does this suggest? This suggests a compression of price. Now here what do you do? How do you trade this? Now this could happen at the end of an uptrend or a downtrend. It doesn't matter where, okay? Now why have I used this candlestick pattern in this particular masterclass? Because this happens very regularly and you should know about it. Okay, this does not suggest that there will be a reversal or there will be a bear breakout. So this could happen at the open of the day also. This could happen within the day also. It could happen at a support. It could happen at a resistance also. So what is important here? How do you trade this? The most important part of it to know is that wherever you see this sort of a contraction zone, you want to see what kind of candlesticks are formed within it, and whenever the high or the low of this particular formation is broken, you can take a trade accordingly. So let's say that this above here is an important resistance and this contraction zone is formed, and then a strong Marubozu candlestick is formed like this here. So then you know that you want to take a long position at the high of this Marubozu, since it has broken the contraction zone, but it has to break. Okay, you don't want a simple wick on the top. So what does a wick suggest? That this is a wick, right? So you don't want a simple wick on the top, and you don't want a green body to be present like this. This doesn't mean anything. The wick doesn't mean anything. It has to be a candle close like this around that particular zone. So above that high, there has to be a candlestick close. The other way to trade this is when it breaks to the downside. So how will it break to the downside? So this will be the break to the downside. There has to be a strong Marubozu candlestick that has broken to the downside. So this is where you can trade this sort of a pattern. So this is an inside bar pattern, okay, or it is also called a Harami pattern. So this inside bar is also called a child candle. Okay, let me just change this color here. Yeah, this is a child candle and this is a mother candle. So this is how they are named also. So various names, but the implication is the same. So this is where you would go ahead and short if the low of that contraction zone is broken. So this is something that you also need to know. If this happens at an important resistance or it happens at an important support, then this is how you can trade for breakouts. So this is not particularly for reversals, but this is a breakout pattern for trading in markets where you know that there is some important supply demand zone or a resistance or support, and then you are waiting for a breakout from that particular zone there. Now let's go to the next slide. Now we are into the sentiment part. What is the sentiment here? How do you know and how do you reckon where the price will go? So that was the third and fourth point, right? So let's talk about that. Now, what does the wick suggest here? Let's say that this is a daily time frame candlestick. And you know that the price has formed this sort of a strong green candlestick. So what do you see here? This is a weak rejection of the price, and the body being strong, you know that there is strength in price. So what can you see from this point? You can say that if there is a prior resistance here, then this particular candlestick has broken that resistance. Since this is a daily time frame, this candlestick is strong. So you might be able to see that if the next day the high of this candlestick is taken out, then there might be a big trend to the upside. So it could be anywhere, the resistance could be anywhere. If this is the resistance, then it has been broken very handsomely, right? And then does this wick really matter? The wick on the top here, does this really matter? So let me mark this wick like this in a rectangle so you'll understand what the size of the wick is. Look at the body here. Let's mark a rectangle here. So look at the ratio there. It's a very small wick, right? It's better than 90%, right? This ratio. So what does this suggest to you? That this is a very weak rejection of price. Now, if this particular daily candle has broken the resistance here, will this wick really be important to you? No, it will not be important because it is less than 10% of the entire body. So now you should understand that the sentiment of the buyers is stronger in the market. So the buying sentiment is stronger in the market, and so given this particular stock or the index or anything else, you might be able to say that the resistance has been broken and now the price will rally up to the next resistance. And similar thing will apply to the downside also. I have not marked the bearish candlestick here, but it will be the same thing for the red candlestick also. Please apply it to the red candlestick also. The same thing will continue. So you can see here that the buyers are very much in control in spite of the weak rejection on the top. Let's see the next one. Now you can see here that we have strong rejection of price. Now tell me who is in control here. Now we can see that the candlestick body is still green. So now let's say there's a resistance here and the price opened at this point and the buyers were very strong. So they pushed the price all the way up here, made a high, but at the high the sellers were so strong that they came down and closed the price up to here. But here the day ended. So does this green color really matter? This is a green candlestick. It does not matter because here you see that there is strong price rejection. And what does this show? The sentiment in the market is bearish. So has this particular resistance been broken? No, it has not been broken in spite of the wick. In spite of the fact that the buyers did take price beyond it, the resistance still holds. And now you can see that the buyers are very much weak. So they're green, but they're not in control because they are basically weak. So they might show a green pattern here, a green color here, but they are definitely not in control. So in the live market, you should know who is in control and then you should be able to decide where the market might go next from there. So you see, you can apply this principle to the daily, to the weekly, to the monthly time frame also, and to intraday also. And it does not matter what color of the candlestick it is, the wick on the top really is what matters. So like you saw here, the buyer's sentiment and the seller's sentiment is what matters on the time frame, and there you should be able to decide which way the price is going to go and whose side you are going to take. Alright guys, so that's the video I wanted to make, a masterclass, the all you need to know kind of video about price action trading and about candlestick formations. Now I have made multiple videos on strategies which you can use in the live market. Just apply these candlestick formations on those price action videos and trade from there. Guys, you all know that I am a pure price action trader. I do not rely on any indicators. I use naked charts to trade on, and you have always seen me making analysis videos in which I try to give you and impart to you the knowledge that I have and that has made me a successful trader. And I want you to use all this knowledge and become successful also. As I just said in the previous part of the video, I'm not interested in making any webinars. I never came to YouTube with the ideology of marketing a webinar or a seminar from my side. I don't conduct any webinars or seminars. Everything you need is available on this YouTube channel, and it is all free of cost for you. So please ensure that you make use of it. This is a goldmine of knowledge, guys. I'm going to keep making all these videos, but I'm making all these videos for all of you guys to start following me and ensure that you start becoming profitable also. So throw away all those indicators. They don't tell you anything. They are just derivatives of price, and start following price actions. Start following candlestick formations. Watch for important candlestick formations at important resistances and supports. Watch for candlestick formations wherever you feel that there is a breakout. See if there is a Marubozu candle at the breakout. See if there is a pin bar candle or any of these candlestick formations or combination of candlesticks at important supports or resistances. And that will give you an idea whether you want to take a long or a short trade there. So I hope you have liked this masterclass, and thank you for watching this video and staying with me for this long. I'm really glad that you're liking all these videos, and I hope you will keep supporting this channel in days to come also. If you've liked this video, please hit the like button, subscribe to this channel, and also hit the bell icon so you're notified every time I post a new video. I'll see you in the next one, guys. Thank you and have a great day ahead. Bye-bye.